The HUD 223F program provides permanent financing for the acquisition or refinance of apartment buildings throughout the country. Common misconception of HUD is when you think of HUD, you think of Section 8 housing, low-income housing, but there's no affordability required to qualify for one of these programs. You can have an asset that's 100% luxury, 100% unrestricted, no rent ceilings in place. If you are a first-time multifamily borrower, it can be a little bit challenging to qualify for one of these loans. In a refinance scenario, that's less of a hurdle because inherently you already own an asset. But if you're looking to acquire a property, HUD wants proof that you or a partner have prior comparable experience. So if you've only ever done fix and flips, now you want to buy a 100-unit apartment building or a 200-unit apartment building, you need somebody on your team that has that commensurate experience. The difference between a HUD 223F loan and a 221D4 loan, there's another video on this channel that describes the D4 program. The D4 is for new construction or sub-rehab, so ground up new construction, or if you have to do more than $45,000-$50,000 a door in repairs, you're forced to go under this 221D4 program, which is a longer process, a bit more paperwork, but still a very powerful program. 223F is for an asset that is up and running, operational, stabilized, and is in pretty decent shape. So you would need an asset to require less than $45,000, $50,000 per door in repairs. It should be stabilized, at least 90% occupancy. If an asset has been up and running for years, 2, 3, 4 years, HUD's going to want to see at least 85, 90% occupancy for the past 6 months. You have a little bit more flexibility for an asset that's coming out of construction or rehab. In that scenario, HUD's going to want to see 1 month of stabilization, 1 month of 85, 90% occupancy before the loan application can be submitted. There's technically no minimum repair amount that's required to utilize this program. If you have an asset that's in perfect condition with no repairs required at all, that's fine. What will happen is during the underwriting process, we will commission a capital needs assessment. It's an independent company that goes out and inspects the property, and they will be defining, are there any life safety issues or quote unquote critical repairs that have to be done? Similarly, are there any repairs that need to be done within a year post-closing? The repairs done within a year post-closing are like doors, windows, paint, generally more cosmetic type of items. General program terms, this is a 35-year fixed rate, 35-year amortizing loan. So it's fully amortizing, no balloons. Again, 35-year fixed rate, 35-year term. So it's actually a longer fixed rate period and a longer term than like a 30-year single-family home mortgage. You can be a for-profit or a non-profit borrower. You don't have to have any affordability component, as mentioned. Leverage is 87% for market rate, up to 90% for affordable. Debt coverage is 115 for market rate down to 111 for affordable. There's another video on this channel that defines affordability in the context of HUD financing. For cash out refinances, it's always 80% loan to value. So it's still underwritten at a 115 to 111 debt coverage ratio based upon whether the building's affordable or not. But the loan to value is always going to be 80% in a cash out refinance, regardless of affordability. You can do seller seconds, like a private subordinate note, but what's challenging with HUD is that combined, the first and second mortgage cannot exceed 92.5% combined loan to value. And more importantly, the note, the subordinate debt, has to be structured as a surplus cash note. But if you have a 35-year HUD loan, HUD in the first position, you'd need the seller to agree to a 35-year note that can only be paid back through surplus cash. It can't really have any teeth to mature before the first mortgage. There are some flexibilities if you're getting a subordinate note or secondary financing from a public source like a city or a government fund, something like that. HUD loans are assumable in the event of an assumption. You do not have to deal with a prepayment penalty, but the standard prepayment penalty, if you are securing a HUD loan and you do want to pay it off within the first 10 years, is it's declining by 1% per year, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. After the first 10 years, there is no prepayment penalty, no defeasance, no yield maintenance, and the loans are non-recourse from day one. So they're non-recourse for the entirety of the 35-year fixed rate period. You can do elderly restriction if you would like. It's optional. Generally, if you're going to be doing elderly under HUD, it would be 62 plus and generally head of household. So as long as you have one tenant that's 62 plus, you could have younger people in that unit. There are some edge case scenarios that allow for 55 plus age restriction, but those are only for assets that have been operating as 55 plus for a long time and meet the definition of affordable housing. And lastly, commercial space can be recognized. We can recognize commercial income to increase loan proceeds, but HUD views commercial space and income very conservatively. They recognize that it can rent for a higher per square foot than equivalent residential income. So they don't want to be in a position where they are anticipating or underwriting off of a huge amount of commercial income. ultimately those tenants end up not renewing their lease or something happens, then you're kind of underwater. So commercial space and commercial income should generally be no more than 15 to 20% of the overall project space or gross income. Common question we get is it worth locking into a 35-year fixed rate loan if rates are going to be changing in the future or volatile? HUD does have note modification and a streamlined refinance process to drop interest rates for existing HUD loans in the most abbreviated fashion possible. Just note that the prepayment penalty is still going to need to be dealt with if you're refinancing or modifying the existing HUD loans note in that first 10-year declining prepay period. This gets technical. You could capitalize part of the prepay into the new modified loan's interest rate, or you could pay it off with cash. We can explore those different options in that scenario. Just know that HUD protects you long and short term, where you can kind of set it and forget it for 35 years, or you have more flexible, streamlined options to drop that rate in the future. Virtually any type of multifamily asset is eligible to be financed. It can be a garden style, 5-4plex, elevator, non-elevator, scattered sites where you have a variety of different assets in different locations, as long as those different locations contain at least 5 units. Renovations, row homes, high rises, low rises. You can't do dedicated student housing. You could have an apartment building filled with students as tenants, but you can't have a building that's kind of designed and tailor-made for students. Residential subdivisions, there are some increasing flexibilities at time of recording with that, but I think what HUD's looking for in the subdivision space is something that's in the spirit of multifamily, where you have a subdivision that contains homes that are all of a similar fit and finish. You might have community amenities like a gazebo or a pool or something like that. They're not looking for kind of quote unquote random subdivisions or like scattered homes in a random geographic area. It needs to be more of a community feel, and they are open to that in the right context. For condominiums, you don't have the flexibility to sell units individually while a HUD loan is in place. You could put a condo regime in place, but you'd have to pay off the HUD loan in order to be able to sell units to tenants. Can't do mobile homes, and you can't do transitional housing, drug rehab, or medical type of housing. In terms of anticipated loan fees, HUD will charge a fee equivalent to 30 basis points of the mortgage amount prior to closing. That's for them to review the final application and issue the approval to close. That will be credited back to you on the settlement statement. There's an additional quarter point that's going to be drawn at closing, so about half a point total between fees paid and reimbursed prior to closing and fees collected at closing. Our fee as the lender, the fiduciary for the government, it's kind of a sliding scale. It's the same amount of work for us regardless of loan size. So for larger loans, it's smaller. For smaller loans, it's higher. But I'd say generally our fee is somewhere in the half a point to a point and a half range. And HUD does have higher soft costs in terms of legal costs, third-party due diligence costs. Inherently, it's a byproduct of it's a 35-year long-term fixed-rate non-recourse note. So there's just more paperwork and documentation and due diligence that is involved in the loan process, which can make it challenging to be economical for loan sizes below $1 million, $2 million, or maybe even $3 million. A particularly nice part about HUD financing, in my opinion, is that there is no tiering of market, so there's no impact to interest rates or leverage or general program terms regardless of location. If you're in a metro market or a tertiary market, all the same programmatic terms. And you could theoretically combine, much like I referenced the private subordinate notes, you can do tax credits, we can recognize tax abatements, pilots on the expense side, grants, HP funds, home funds. As long as we can thread the needle and prove to HUD that whatever equity you're getting is going to be abiding by their guidelines, that should be fine. Similarly, on the ownership side, if you want to do like a preferred equity type of structure where you have you're in your org docs, certain people get certain cash flow before others, that should be fine as well. Lastly, some considerations. As noted, HUD is not as economical for smaller loan sizes, $1.5 to $3 million, due to the timing and the processing and just the soft costs that are involved. Similarly, if you are presently managing the asset as a mom and pop, you're doing stuff back of the napkin, you don't have QuickBooks, it can be challenging for you to remain in place as the management agent. In a scenario where you have no prior HUD experience, kind of a limited management portfolio, HUD may require you to bring in a consultant to assist with paperwork during the closing process and post-closing, or they do have the discretion to request that you bring in a wholesale third-party separate manager. That's one of those items that we could address with HUD early on before you start spending any time or money on the process to vet that out in advance. If a property has tenant at wills, month-to-month tenants, short-term rentals, Airbnbs, that's going to be a challenge. So HUD will not allow you to secure financing if your asset has any tenants or any leases that are less than 30 days. So you have to have everything at least a minimum of 30 days. And if you're going to have short-term rentals, 30 to 60 days, 30 to 90 days, something like that, it should be no more than 10% of the overall project units. And it might be challenging for us to recognize that revenue in our underwriting if you're currently getting a premium for that over whatever the equivalent market rent is. Properties that have mixed level of completion, if you have an asset where it's partially renovated, partially not renovated, HUD's going to want to see everything at the same fit and finish before you come to them for financing. In an acquisition scenario, it can also be challenging to use this program because generally it takes about 5 to 6 months to close. We are going to be having conversations with HUD and yourself and making sure that we're very comfortable that the transaction will close before you spend any time on the process. But ultimately, does a seller want to wait 5 to 6 months or 6 to 7 months or even 4 months for somebody to get a HUD loan? Oftentimes it's more economical, makes more sense to acquire property with a bridge or a bank or a credit union or a faster moving source, then come to HUD to do a cash out refinance to recapitalize ownership. Once the dust settles, you've improved the bottom line. Similarly, we cannot underwrite on pro forma rents or hypothetical rents. There's a little bit of a push and pull there, right? If you're going to be buying a property or refinancing a property and doing capital improvements, maybe an appraiser could justify slightly higher rents than what you're collecting right now, but we're going to be looking at what are you collecting for rent, not crazy hypothetical numbers that have no bearing with reality. And lastly, I highly recommend there's a document called the HUD 92466N, the Multifamily Regulatory Agreement. This is publicly available online. This document delineates all the requirements that HUD has for you post-closing, like replacement reserves and cash flow distributions. Highly recommend reviewing that because that gives you a pretty good idea of what you will be agreeing to as part of the closing process. And finally, some frequently asked questions. So you will receive credit for any money that you spend in advance, as noted. So if you're spending money on an appraisal or an environmental report or capital needs assessment or that HUD application fee equivalent to 30 basis points, all of that you spend prior to closing will be credited back and rebated to you at closing because they're mortgageable costs. Theoretically, if you had a pretty significant amount of work that had to be done in a building, when you exceed $15,000 a door in work, you may need to bring in an architect or a general contractor, depending upon the scope of work. As a developer's fee, you can secure a developer's fee if you're a nonprofit borrower, if you're using LIHTC, or you have what's called a RAD deal, rental assistance demonstration. But in broad strokes, you don't really need a developer's fee, particularly in a cash-out refinance scenario, because you're pulling equity out of the project, which is generally going to be larger than a developer's fee. If you want to include a mortgageable developer's fee as a nonprofit borrower, there are limits on what we can include as a cost. That's assuming that you're not going to be doing a formal cash-out refinance. We can explore that in more detail upon request. HUD technically does not have any liquidity or FICO requirements, minimum net worth, but I use the Ferrari analogy in all these videos, which is if you went to a Ferrari dealership and you wanted to buy a car and you had poor credit and no money in the bank, you probably would not walk out of the dealership with a Ferrari. Similarly, if you're coming to HUD to finance an apartment building and you are thinly capitalized, it's unlikely you're going to qualify as a borrower without bringing in some other partner that's a bit more of a heavy hitter. And we can do deals that are ground leases, but there's certain conditions that HUD has that you have to abide by that I can provide to you in advance. So in general, it's a commercial real estate loan. It can be a little bit intimidating. It's a bit of a longer process. It's a bit more fee heavy. It becomes a cost benefit analysis to say, do the terms that I get outweigh some of the downsides of processing and timing? Generally, for a cash out refi, it's a very, very strong program. It's certainly worth running the numbers and comparing the HUD 223F compared to Fannie, Freddie, or other options. So if you're interested in exploring this program, call me, email me, text me anytime. I'm always available. Happy to run through the numbers, and I appreciate you watching.